Well, that was Sunil Mitra talking about the Indian Mobile Congress. We're joining us on Power Lunch. I'm Harsha, Subramaniam.
Good afternoon. I'm Dugal. Slightly shortened version, but doesn't mean we don't have important stuff to talk about. Starting with the markets, both equities and currencies not turning out to be another good day. The Sensex down 280 points. We've got Neeraj with us. Neeraj, what's happening in the market?
It's even more region-specific, Hira, because I was looking at what the European futures are doing, or European markets or the Dow futures are. They're in the green. So it's even more specific to us, the weakness that we have today. Maybe on the currency as well, and you'll be a better judge there. But on the equity markets, for sure, it is not looking good. The broader markets too, which started off really well, and I think they've come off. So the market breadth must be looking terrible. The Nifty Bank has failed to defend. This is the market breadth. Okay, let's first this. We started off really well, and now we're widened to the lowest point of the day, the worst point of the day in terms of advance decline. And the Nifty Bank has failed to defend that 24,000 mark currently. It'll be very, very interesting to see if we go further lower on the Nifty Bank, then the kind of positions that get unwound and the resultant pressure that it puts on the Nifty as well. So this doesn't bode well from an expiry perspective or otherwise. But interestingly, it's not just about banks. Pharma is taking it on the chin today. So maybe because of Divi's, and maybe that was a trigger point. But Sun, Divi's, Torrent, a bunch of other names. Wockhardt is down about 3.5%. So Pharma has kind of had a bit of a dent today. What is bucking the trend is IT. But by and large, heavyweights like banks, pharma, etc., are all of them trading in the red. It's not looking a good day today.
Just a broader thing as well, Neeraj, and I'm going to ask them to bring out this chart of fund flows as well, and how fund flows have panned out, in the last couple of months. What's the sense that you're getting when you're talking to larger investors? Is the confidence waning? So,
well, maybe that they don't speak about it explicitly, but Harsha,
there you go.
Yeah, this is flows. Okay, yeah, and. So one, it's not been a non-regional phenomenon. I think EMs by and large have seen a drawdown, but just a conversation that we had with the JP Morgan guys at the sidelines of the investor conference, and they mentioned that specifically with India, they're asking all of the top clients to stay light on India. One, there are growth concerns. They were at the higher end of the growth forecast and they're coming off. But even the valuations, they thought, irrespective of the GDP growth, the valuations by and large they thought were expected. So imagine for a large brokerage like JP Morgan to come out and say that they're asking clients to stay on the sidelines on India. Macquarie in the research report states that their clients, they didn't ask clients to do anything, but their FI clients are generally not bullish on a lot of pockets, including BFSI, which is a heavyweight. It just shows you where the inclination of the foreign investors is. Even if it is there in the EMs, it's not on India currently.
Neeraj, thanks so much for that. Actually, the currency market's not looking that great either. Sometimes it ends up being a spiral. Bond markets react to a trigger like the fiscal deficit, so yields go up, then the currency starts to weaken because they think that there'll be outflows from bonds, and then as the currency weakens, the equity market starts to get a little bit worried as well. On the currency today, important to just point out that technically the rupee is looking weak. It slipped actually below the 200 DMA, which was at about 65.51 levels. Most analysts or most traders had said that level will hold. It hasn't held. Saloni is standing by with a technical check, but also a sense of what traders are talking about this afternoon on the rupee. Saloni.
So the rupee actually continued its 5-day losing streak, and it has weakened further to hit a fresh 6-month low of 65.75 levels against the US dollar. Now, going by the technical analysis, the rupee has actually broken the 200-day moving average, and it is now trading below that level for the first time since Feb 2017. And Mr. Prameet Brahmabhat, the CEO of Veracity Financials, also believes that the rupee did break the crucial level of 65.70, and he further expects it to depreciate to 66.20 to 66.40 in the coming next 4 to 8 weeks. Also, going by the weekly performance of rupee, it has depreciated close to 90 paise. Why? Because of the foreign fund flows, and also very strong dollar overseas has weighed on the rupee particularly, Ira.
Saloni, thank you for that. Deven Choksi, Managing Director at KR Choksi's Investment Managers, now joins us on this conversation. Deven, good having you on the show as always. What do you make of the markets at these levels? There have been concerns over valuations for a very long time now. Is this the beginning of the sell-off? All right, we seem to have lost Deven at this point in time, but that's the Nifty for you, trading at about 9,800. Ira, the interesting point was, this is the longest run since December that we've had, this losing streak running 7 days in a row that we have seen a sell-off continuing. Neeraj spoke about the various pressure that the market is going through. But bring up that chart and tell you how the weakness has sort of crept in since December. That's the one. In September alone, I mean, we reached on 19th of September the 10,178 levels. From there, here we are. And the pressure has also been built merely because you're also seeing significant amount of outflow from foreign institutional investors. Net outflow yesterday alone was about $4.5 million. Although if you look at it from 2017 perspective, $6.2 billion of stocks have been bought. But purely from the month of August and September, there have been net outflows. Devin Choksi is back with us. Devin, I was asking you about valuations. Many people have been expressing concern. What do you make of the price at which stocks are at right now, and whether this is the beginning of a sell-off?
I think, good afternoon first and foremost. The important aspect I think about the growth. So we are not likely to see a drop in the corporate earning growth. We are likely to see an improvement in the earning growth. So even if in some cases where I think they have scaled up, my reading says that it will catch up with the earnings as we travel in this particular financial year. Already we are seeing green shoots in some areas. We have seen the record inflow of new orders for the capital goods segments. Cement as a sector I think is doing well. We are also seeing automobile numbers I think on a positive side. Banking credit on the retail side is I think already started picking up. Government expenditures are picking up. So if you see each of these areas, probably I think you get only one That's where I feel comfortable that I think it is not because of the valuation concerns that somebody is selling out from this market. If the FIs are selling out of this market, I think you should look at their actions somewhere else. They have been basically using this money to invest in some of the other emerging markets. If you see the return that they have earned out of the other emerging market in last 3 months, kind of doing the ETFs in the Indian market and investing into the other markets of the world. So I don't think that I think we should be seeing our country and the corporate working as negative at this point of time. And the country, I feel that I think more and more long only funds are lined up for investing into Indian markets. So I think I would look forward to that kind of a possibility emerging faster at this point of time.
Right, Mr. Choksi, we are having a little bit of trouble with your link today, so I think we'll just close it off for this conversation. Thanks for joining us, though. Mr. Choksi clearly looking at the glass half full rather than half empty. There are many sort of counterpoints to some of the points that he was making. But for now, we won't focus on that. We'll focus on comments coming in from Rajiv Kumar, the chief of Niti Aayog. The RBI's asset quality review was probably too harsh. The new chairman of the Niti Aayog, the new vice chairman of the Niti Aayog, Rajiv Kumar, told BloombergQuint. He said that banks were forced into losses due to RBI's move. Surprising, because remember, the RBI didn't change any rules. The banks simply weren't sticking to those rules. But nevertheless, hear those conversation out between Praveen Chakravarti, contributing editor at BloombergQuint, and Rajiv Kumar.
It began to be known for 3 years. I mean, that process has taken, actually, it's only in the last 1 year or so that the enormity of the issue, the enormity of the problem has really come up, in some cases, right? I mean, that some of our public sector banks are sitting with more than 20% or so NPAs and their net worth is wiped out, etc., etc.
Because of that asset quality review that we got done.
Yeah, but I think the asset quality review, pardon my saying it, but maybe was a bit too harsh.
Yeah.
And
I know there's that school of thought. Yeah.
And second, and especially I say that especially because there were a lot of projects there which were dependent on government payments and receipts from government departments, which were delayed inordinately, and that then made those projects in some sense unviable, financially unviable.
But if I'm a creditor, why should I care?
No, if you're a creditor, why should you care? That's all right. But the point is that if you're a public sector bank creditor,
so right hand, left hand.
Yes. So why not, Baba? I mean, this is something that you could have done, and you could have had a different treatment for those NPAs, which are dependent upon government payments. So that's one part.
Okay.
The second part of it, that 70% of your bank is sovereign guaranteed. So it's not going away anywhere. I mean, it's not as if you're going to get a bank run tomorrow.
Sure.
So that also meant to me that, this whole 360-degree asset quality review and repeated, etc., I'm not for a minute supporting evergreening of loans, etc., etc. Those who are willful defaulters should be punished, should be given exemplary punishments, as has been done in some cases. And now with the bankruptcy code, take them, drag them there. But there is a large number of people who were probably in a situation to get on to the, to be able to get back to, in the black, which we have forced banks to push in the red. And the latest that I read, was it an order from SEBI that said that if you're overdue by a day,
you have to report.
Hello, I mean, what's, so that,
so you don't think it's a good idea?
Do you? I mean,
see,
but and just let me just complete that sentence, which is that I think it's time now for us to be a little more nuanced. In our situation. And second, it's also time to take the bull with the horns, accept that there is a problem here, and recapitalize the banks.
Recapitalize it.
And improve the allocation, budgetary allocation of rupees 10,000 crore by a factor of
10.
Well, yes, I mean, you said it, but but the point is that whatever is needed.
Sure. And how we get the money for it, we'll talk about later. But
my sentence is do whatever is needed. To get that thing off the off your problem book.
Okay.
Otherwise, there is nothing that can happen.
Sure. So bite the bullet, increase budget allocation. That's on NPAs. But we're talking about private investment. The other big clamor is for interest rates. The fact is, I mean, I'm there. I actually don't subscribe to this call for lower interest rates. Maybe we disagree there, but my simple
why don't you subscribe?
My simple argument is this: repo rates are down 200 basis points, 8% to 6% since this government took over.
In the last 3 years.
Yeah, in the last 3 years, right? That is, I mean, clearly private investment is still down. Where is the evidence that interest rates? I mean, I'm presenting a counterfactual to you. And I'm saying it's down 200 basis points. If anything, private investment has only gone down further and further in terms of credit flows. So why are we holding up interest rates as the villain in this?
Well, one, I think it's a signaling argument.
Okay.
Which is that what will the government do to revive private investment? How far will it go, as it were? And according to our friend Surjit Bhalla, it's also an argument to say that accept your mistake that you got your inflation expectations all wrong, and therefore don't punish the innocent because you think there's some hidden guilt, as it were. So that's the one part of it.
Okay, so it's a signaling.
But the second part of it is, I think, there I would agree that it's not, maybe the interest rate cut is a condition, may not be a necessary condition, but it's not certainly a sufficient condition. And the sufficient condition is for us to create the demand for credit in the economy. If you talk to the bankers, they would say, we are willing to lend, but where are the projects? Where is the investment demand? And that is for two reasons. One, as we know, for 3 or 4 years, we've suffered with excess capacity. There's under capacity utilization in the system, and therefore if you're sitting with that, and if your output gap is positive and large, of course there won't be any investment demand. But the second thing is, this is where I've argued for the government coming in with large infrastructure, low gestation projects, which on an EPC basis, which will in some sense revive the investment climate and get some of the large companies to begin demanding credit on viable projects. I mean, just give you one example. Affordable housing. Let's say, if you want to build,
Though I think all housing is affordable to someone at some price, but it's a low-cost housing.
Low-cost. Touche. Low-cost housing, 30 square meters, for which the Pradhan Mantri Awas Yojana gives us a subsidy. That one, if you de-risk that project, by acquiring land and getting all the approvals, etc., and you say that you want to build, 100,000 houses in somewhere, and then invite private bidders, the same builders, and they come in, they will then go to the bank to get the working capital. And that will then, get the demand going, the credit demand going. And once you got that, and then all the 200 multipliers start working, and you got a priming of the economy, not through just pushing up consumption demand, but by actually improving investment climate.
Rajiv Kumar from the Niti Aayog. Piramal Finance, meanwhile, has made its foray into the home finance space. While the initial focus is on metro cities, the NBFC has ambitious target of having a total loan book of 15,000 crore over the next 3 years. Vishwanath Nair, who was at the press conference today, joins us with details. Vishwanath, what is the company planning to achieve and what is the target?
That's right. This target does seem ambitious of having 15,000 crore worth of book within 3 years. What the Piramal Group intends to do is leverage its real estate developer network, which it has built over the years through its Piramal Finance business. The Piramal Group says that it will offer home loans to the customers of these real estate developers, therefore forming a B2B2C sort of model. Apart from this, it will also use technology to better underwrite some of the loans that are being given out. Now, Piramal Housing Finance will target salaried as well as self-employed customers. And typically other lenders have stayed away from the self-employed group because of the high rate of NPAs and because of inadequate underwriting tools available. What Piramal Housing says is that since the group has invested in Shriram Group, which excels in lending to such customers, they have the know-how and they have the experience to be able to lend to the self-employed group and therefore be able to grow its book faster. So apart from all of this, of course, the Piramal Housing Finance business has been active over the last 20 days. And in these 20 days, the business has created an assets under management worth over 200 crore. This is what Ajay Piramal is saying is testament to the fact that they will be able to grow really fast over the next 3 years.
We have more than 15 plus developers who have already asked us to start working and start disbursement of loans in 30 of their projects. We have connectors, 500 plus 50 DSAs who have been empaneled with us. And all this has resulted in an AUM in excess of 200 crores in the first 3 weeks of our play. We should be able to get to to a loan book of 15,000 crores by 2020.
The home finance market where every financier is heading. Moving on, Divi's Laboratories may not be out of the woods as expected. The US drug regulator has issued a Form 483 after its recent inspection of Unit 2, and the observations do not appear to be entirely procedural in nature. Darshan Mehta standing by with the details. Darshan.
See, Ira, if you're looking at the observations, we have the observation and they don't look procedural as what the management has said. So the first observation that is there, it says that the company failed to test individually batches of some of the products which were shipped. So now, as far as our analysis is concerned, this is a serious observation. We were surprised because in earlier cases what has happened was some of these other companies had to recall these products. So we are indicating that, we are surprised why Divi's has still not been able to recall these products. So that's a little bit of serious observation. The second observation that is there is that the lab failures are not thoroughly investigated, which means that different data was coming out at different times. This is pointing to a little bit of data integrity issues, which is serious. What we are saying is this is a repeat observation from the last 483 that was there, and it actually looks rather serious. So this is a serious observation. The third observation is also serious. It indicates that sample injection sequence, so whatever sampling was done and what the final outcome was there was different. So there is issue of data integrity here. This incident, this also is a repeat observation from what was there last time around, and it is rather serious this time around. The fourth observation is that there is no documentation to ensure cleaning procedures are effective. This also raises concerns as far as contamination and microbiological issues are concerned with Divi's lab. This also is a repeat observation from last time around. So there are 3 repeat observations that are there. The fifth observation is does not have adequate cleaning instructions for major equipment. This is a very minor observation. It won't have any impact. It's a procedural in nature, but in fact it's a new observation that was there last time around. And the sixth one is also rather serious. Batch records are not always done at the same time when the operation is done. This actually points to data falsification because documents were signed even when the activity was not done. So this point, so there are 3 repeat observations in this Form 483 and 3 of them point to data integrity. So this is slightly better than last time around when the import alert had come in last 483. The import alert stays, so financially nothing changes for Divi's lab. But what this means is that the market which was anticipating that the import alert will be listed very, very soon and Divi's again will be able to export it, that actually goes down the drain because these observations are rather serious and it probably will take more time for Divi's to get the remediation done and the US FDA to clear this plant. You can clearly see Divi's trading at pretty much the lowest point of the day.
7% lower in trade today. Darshan, thank you so much for joining us. That's the problem with DVs and what it's facing with the US FDA. The new kid on the block, ICICI Lombard, swung between gains and losses after listing it at its discount to the issue price. The general insurers, however, is confident of growth prospects. In a conversation with BloombergQuint, Ridhima Saxena, Managing Director Bhargav Dasgupta said ICICI Lombard is taking several steps to improve risk selection and defended its investments into equities. Listen in.
We fundamentally believe that if you look at investing long term, and insurance business in India, the general insurance business actually has a long tail in terms of the claims that come over a long period of time. So there's a lot of funds which stay with you for a long period. Now, if you look at long-term investments, we believe in the Indian market, equity still is the best, asset class to invest in. And our performance over the last, 3 years, if you see, has consistently demonstrated that in terms of returns that we've had on equity. So we believe that that's something that is the right thing to do, and we will continue to have a reasonable allocation of our investment book towards equity because that's the right asset allocation strategy that we believe is appropriate.
All right, that's ICICI Lombard. Not the best of first day performance on the bourses.
Out of time on this show. Thank you so much for joining us. Coming up next is Ask BQ. Give us all your queries. That's coming up next on BloombergQuint.